Well, we got a bit of a roller coaster ride in Canada's jobs data. 81,100 new jobs reported created in the month of August. That followed, of course, a drop of 24,200 in the month of July. So what are we to believe? Who better to ask? Benjamin Tal, Deputy Chief Economist at CIBC Capital Markets. So Benny, obviously these are notably kind of unreliable surveys, but this seems particularly unreliable that you could lose so many one month and gain so many the next. What do we make of it?
Exactly. It doesn't make any sense. And, you know, we gain all of a sudden 20,000 new jobs in education during the summer. That doesn't make any sense. Regardless, listen, the labor market is fine. It's not booming. It's not 80,000 a year. It's not negative 20. It's something in between, more or less where we should be. However, it's not negative, and therefore the Bank of Canada is not thinking about moving in October. It's simply too early, and that's why the market is now shifting expectations to December. And why December? Because the Fed probably is going to ease, and as the Bank of Canada, you don't want to be on the sideline in this kind of situation. So again, the job market, fine, but not 80,000 by any stretch of the imagination.
So it's interesting, we have these remarks from Jay Powell today that, obviously U.S. investors will parse very closely. He's sort of saying, the days when a rate cut can revive an economy are maybe behind us. Do you think, given that fact that we may be headed for a slowdown, that there could be some shocks, right? We could still get a big trade shock that we haven't seen. There are certainly external shocks. Brexit is still out there. What else can the central banks do? What do they have in their back pocket if they did need to help economies, including Canada's?
Well, not much, quite frankly. Central bankers are becoming impotent in this way because, the effectiveness of monetary policy is going down with every cut in interest rates. And we're seeing it now with the Fed, clearly with the Bank of Canada. And that's why Trump has the green light to go with fiscal policy. So for the first time, we have monetary policy and fiscal policy moving in the same direction. Monetary policy is helping, but less because it's less effective. But ironically, fiscal policy is becoming more effective because private investment is not there, so public investment will not be stealing private investment, so that makes it more effective. So both of them are moving, fiscal policy more effective than monetary policy, but there will be enough, maybe, to prevent the U.S. economy from going into a recession.
And of course, we are going to see fiscal very much in focus here in this kind of election period. There will be promises made, even without an economic slowdown. Just characterize for me how you think we're doing. I know that just based on percentage of GDP, many economists are not overly worried about our deficits. But if we did have to see a real kind of fiscal stimulus push, is there a point at which we should begin to be worried?
Well, clearly, in the U.S., we are reaching a situation in which the budget deficit is unsustainable. But, I think that there is logic to the madness when it comes to Trump. If you think about it, he's maybe outsmarting all of us. We have a situation in which he created this trade crisis with China. So you have this fog of uncertainty that we discussed in earlier shows. And, so he got the Fed cutting interest rates. So that's one boost to the equity market. The second is the green light to spend and fiscally. So he's going to do that as well. That's another lift, if you wish. So you have monetary policy, fiscal policy helping. And in the last possible minute, he will announce a trade resolution with China, which will be the third lift. So it's basically triple dipping, if you wish, that will keep the market going. I think there is logic to this madness.
If there is logic to that madness, if there's actually a strategy here, and I think you're being very kind, but if there is there a danger of trying to game it too much? In other words, the best timing for that would be just in time to win an election. That's a long way out. Does he do enough damage to economies globally between now and then that you can't pull it back from the brink? That's
the key question. First of all, clearly this is not an optimal economic policy.
Right.
But it can out to be a good political strategy for re-election if you time it right. So if that's the case, he will need a solution, a trade agreement with China early in 2020 with enough time to get some movement in the stock market and clearly in the economy. he can time it, and maybe that's the plan. Who knows? But I think that's basically where we're going. And this agreement, by the way, will not be an agreement. It will be something that the Chinese will be willing to live with, something that he can go to the farmers in the US and others says, listen, I'm saving you from China, something along this line. It will not be a real agreement because China will never change the way they do business. It will be artificial. Nevertheless, enough for him to say, I'm saving the day, get another lift. Maybe.
Are you on board with our central bank thinking in terms of staying where they are and just kind of signaling that they're comfortable where they are?
Yes, surprisingly. Usually I disagree with them, but this time actually I must agree with them. What they're telling you, they're basically buying time. They're telling you, listen, our staff is doing the research, let's wait and see what they are saying. But I'm saying all this research will not help if one tweet changes everything, yeah? So clearly, what's happening with China, the US, the dispute will impact what we are doing. You can do all the research in the world. That's not enough. You need to know what's happening with China and the US. So they are buying time. They are clearly not ready to move in October, and they were hinting that that's the case. And especially after the labor market numbers today, they are not going to do it. The market is already adjusting. They would like to maybe move in December, but maybe only one move with the Fed moving twice. So basically half the rate we see in the US.
All right, Benny Tal, always great to have your thoughts.
A pleasure, thank you.
CIBC Capital Markets Deputy Chief Economist Benjamin Tal.